Watching an emerging market economy face off against the world's economic superpower on trade would have been unthinkable a few years ago. But the showdown between the US and China has shown just how much the world economy has changed. Last week's Stage 1 deal removed some of the uncertainty that's hung over the economy, and particularly emerging markets, but it's also added some new uncertainties. Number one, the extra $200 billion of goods and services that China has agreed to buy from the US over the next couple of years will influence trade flows, and we'll talk a little bit about that in a minute. But also, and probably more importantly, this very aggressive move towards bilateral deals and away from the WTO will have big, big ramifications for trade around the world and for emerging markets. So my name's Thorold Barker. I'm the editor for Europe, Middle East and Africa at the Wall Street Journal. And against this backdrop, we're going to discuss the outlook for emerging markets this year. And we have a fabulous panel. His Excellency Mohammed Al-Tuadri, Minister of Economy and Planning from Saudi Arabia. Alicia Bárcena Ibarra, Executive Secretary of the United Nations Economic Commission for Latin America and the Caribbean. Keiyu Jin, Professor of Economics from the London School of Economics, and Bill Winters, the CEO of Standard Chartered Bank. So please welcome our fabulous panel. Thank you. So Keiyu, I'd like to start with you as a China expert. How much has this trade showdown actually affected the Chinese economy, which is something that affects emerging markets so much through commodity prices and global growth and other things? So how much has it actually affected the underlying economy?
It has affected the Chinese economy for sure, as it has affected the US economy and the rest of the world, especially emerging markets. For emerging markets as a whole, we know that manufacturing investment has gone down, and that's a direct impact of the trade. But also what's really important is that risk aversion in the whole world has gone up. And who suffers? Emerging markets. Capital flows back to the safe haven. So it's through investment and trade and general uncertainty that has affected the economy, and that's also true for the Chinese one as well.
Okay. So when you look at the agreement, Bill, does this solve anything, or what are the actual implications of this, and how much more work is there to be done to get back to any sort of status quo on this?
Look, first and foremost, it's a truce, and that's a good sign in a battle that had been escalating. Second, there are some concrete commitments from China to open up sectors and stiffen protection for intellectual property and the like. Those are good things. And obviously, the U.S. is partially rolling back tariffs, so it's not. I wouldn't say it's a material reduction in the tariff burden, but it's a step in the right direction. So for all those reasons, it's impactful. But it's clear that without a second phase, the phase one deal will come under tremendous pressure over some period of time.
But are there some winners from this? I mean, for example, this $200 billion of extra goods and services, that's going to mean that China has to buy from the US, but then that will cause disruptions elsewhere. Are there any actual winners that come out of this in emerging markets, or was everybody losing from this?
Well, I think the winners, as the deal was designed, are U.S. farmers who had been the big losers before. So I don't know whether they're ahead or behind over the 2-year period, but probably a bit behind. But the Chinese were never going to run out of soybeans. They were going to buy them someplace, and now they're going to buy them from Americans, which means the price will be a little bit higher for American farmers relative to others. But supply chains will reconfigure independent of this phase one deal for many reasons. One is the phase two deal is completely unclear at this point. So manufacturers have been hedging their bets. Chinese manufacturers are hedging their bets with facilities outside China, and non-Chinese manufacturers are hedging their bets. And the winners are places like Vietnam and Thailand and Malaysia, Indonesia, even India, who are having an accelerated investment from Chinese and non-Chinese companies who are making sure that they can accommodate a resumption or even a continued level of tariffs.
Okay.
Can I just jump in? Let's just be clear. There's nothing really substantive about the phase one deal.
Right.
You get the Chinese to buy more stuff American. That's probably the easy part. The fact that the Chinese people will somehow have to consume $2.4 billion of American nuts is going to have to happen. But that also means that it has to shift away from suppliers, New Zealand and Australia. And these are actually the ones who are going to be losers as well. And so even we have a bilateral trade agreement, that's the essence of the problem, is that lots of other countries will have to have subsequent bilateral trade agreements, and China might have to commit to other countries, well, we don't buy your nuts anymore, we're going to have to buy something else.
So what does it mean for Latin America, Alicia? Obviously, a lot of the economies have a reliance on commodity prices and are exporters of commodities to China. How much does what's going on between China and the US affect the already quite weak growth in Latin America?
It has affected a lot, basically because the main trade partners are China and the US. China for South America and the US for North America, let's say. So whatever happens between the two impacts in many phases. One, the commodity prices, they have gone down, except oil because of the crisis recent with Iran. But the second factor is that trade in general is been dropping. So exports went down 3% last year, imports 5%. So trade in general has been affected. Now, in the short run, Brazil, for example, or Argentina benefited because they were selling more soybeans to China. So in a certain way, in the short term, some countries were okay.
But they'll be selling less soybeans now.
Well, that's exactly what we have to calculate right now. The other thing is that from China, maybe you can tell us a little bit more about it, some companies are leaving China and are reinstalling themselves outside of China. Many went to Bangladesh or India or Vietnam, but some of them are coming to Latin America, basically Mexico.
Okay.
So in general, I would say the impact, of course, is big, is huge. This is a region that is basically dependent on exports, the predominance of the external balance. So this region, whatever happens with China, first trade partner of South America, the US first trade now. Now Europe also plays a role here. And I think we haven't spoken about that, but Europe indeed is going to also play like a third-party role. I don't know exactly what will be after this agreement. The other thing that I think is good news, at least for Mexico, is the approval of the trade agreement with the US. And Canada will probably do so very soon, which is also going to bring certainty, but is also disencouraging Chinese investment, for example, on the car industry or Germany or so forth, because it's more focused on the whole chain of production in North America.
Okay. And Mohammed, Saudi Arabia, obviously a close relationship with the US and obviously a close relationship with China as a big buyer of your oil. How much does this new world concern you as you try and reinvent the economy away from hydrocarbons to a more diversified mix?
First of all, I think what I hear from the discussion is that, the definition of emerging markets, how close you are to China and maybe the rest. I think this is one way of looking at it. Saudi Arabia have been through this transformation journey for 3.5 years now, and we think our transformation will hopefully lead to some of the emerging market solutions. Whether you look at us as a major oil or energy supplier to the world, and how that affects our customers globally, lighting up the world. Whether you look at Saudi Arabia as an investment powerhouse and where that wealth is invested to make sure some of the developments in the major markets takes place. Whether you look at our own Vision 2030 programs, for example, one of the main pillars of Vision 2030 is to be in the heart of the Islamic and Arabic world. With this definition, there are a lot of emerging markets, which means Saudi Arabia, through its wealth, will build infrastructure, will employ millions of people to develop that infrastructure. So we think, yes, we are privileged, wealthy, but we also have a responsibility to make sure that our solutions is two ways, to emerging markets and from emerging markets.
But are you concerned about, as stage two, which may well not happen, but as stage two develops and there's this whole question around technology standards and other things, are you concerned about the need to pick sides here, that you'll be asked to pick? Are you part of the China sphere or part of the...
I think this challenge is everybody's challenge. This is not specific to one country or the other. The data question is also a major question for all emerging markets. I think every country will navigate their own way to resolve this. This trend has been in Davos from last year to this year and still not being resolved.
And on this picking of sides, I think the US assumption is that there'll be a good choice for people. When you look at emerging markets, where do you see the center of gravity in terms of whether people gravitate towards the US or to China nowadays, when it comes down to it?
I think the perception that China is somehow very different, ideologically different, doing its own development model, and all the criticisms around it, I think it's primarily a U.S. view and with certain Western countries. But that's not the general perception anymore from the rest of the world. Recent surveys have shown that they are very, they admire China's economic development and wants to learn a few things from the model. So I think the perception is quickly shifting. And also, we're talking a lot about trade, but don't forget there's investment. China is filling the infrastructure gap in Africa, doing Belt Road, and a lot of these countries are very welcome to the idea.
Just to add to that, on financing, Western banks have pulled back quite a lot from some of these countries, particularly sub-Saharan Africa. Does that financing from China really change the dynamic in terms of where these countries are going to turn in this new world?
No, it definitely does. And you're right that Western financing has pulled back in some markets.
Yeah.
Not Standard Chartered. We're still operating in 17 countries in Africa. We've increased our commitment to Africa substantially. And a big part of what we do, in addition to using our own balance sheet, is bringing in third-party capital, which is coming disproportionately from China or Chinese-related entities. I think the projects, earlier stage Belt and Road projects, were a little bit more government to government. It felt like a diplomatic deal rather than a market deal per se. More and more, we're getting into projects that are independently validated and viable, and bringing in third-party capital, which banks like us can help arrange and bring in. When it comes to the question of having to choose sides, first of all, I hope we never are in that position, because the world would be much less well off if we were forced to incur the friction cost of another bipolar world, but this time bipolar economically. So I hope we could avoid that. If we go that way, China's extensive trading and investment relationships, as Keiyu said, are pretty central to more or less 2/3 of the population of the world.
Bill, I think this is also a question of ESG and the agenda, environmental agenda. Emerging markets are in different phase around coping with these challenges, and not only banks, commercial banks, but also asset managers. We're also looking at these variables very seriously. I think this is a big challenge facing emerging markets in the future.
Well, let's move on to that. If you look at ESG, obviously a big topic here in Davos, and the environment particularly. One of the striking things, if you look at the growth figures for this year and next year, is that China is by far the biggest emerging market. Questionably whether it should be an emerging market. We can maybe talk about that later on. But it's still growing at 6%, which is way higher than, I think, virtually any other emerging market. So it's very big, and it's still the fastest growing. Why are there no other Chinas out there? And secondly, in a world where starting at the bottom of the value chain in dirtier industries and moving up is going to be more challenging, how do you raise up that wealth level when you don't have that ability maybe that you did a few years ago to do the dirtier, lower value stuff to start off with? So I don't know if you have thoughts on that in Saudi as you go through this.
I think our thought in Saudi is slightly different, because our focus is driving the non-oil growth. And in that sense, we've been very successful in the last couple of years. The whole essence of our diversification model is to move away from oil. But again, Saudi Arabia is in a different phase of its development, transformation, commitment from the leadership, the nature of assets, unlocking some of the sectors is one solution we found very effective. Tourism, culture, sports, these are new sector to Saudi Arabia and driving growth. I think every emerging market should discover their own way of unlocking somehow a potential they have.
But is there a country you look to that you think has done particularly exciting things that are relevant for Saudi?
Again, we learned from the global footprint, emerging markets and others.
So there's no...
Absolutely, yes.
So tell me the Latin American context.
Well, I think in Latin America, the problem is that this is a region that has been basically extractive industries are the basic element, especially in South America. It has been very difficult to diversify the economy. Some examples in Brazil are very important, some examples in Mexico. Argentina, as you know, is in a very difficult position right now. So, the growth is very sluggish in the region. It's going to be this year 1.3 at the most.
Yep.
Last year was 0.1. So we are in trouble in a way of how to look for engines of growth. Now, in terms of energy, for example, it seems to me that still the region is very much based on fossil fuels, honestly. You look at Brazil, they're looking at oil. Mexico, of course. You go to Argentina, Vaca Muerta. So when you look around, honestly, there's no real investment on innovation on energy. Exception I see in Chile, which is a country where private investment incoming to invest on renewable energies, for example. I would say also something that China has been very positive for South America, in particular in the digital economy, coming with more investment that is becoming very interesting.
But how do you in this world where trade arrangements are in flux, it's not exactly clear, the WTO's been defanged aggressively by the US, how do you persuade people to come in with that investment into Latin American countries that will take you to the next level when it's not really clear what the terms of trade are going to be?
Well, you see, the thing is, I think in Chile it has been successful because they have put in place a long-term program and regulations. Basically, most of the renewable energies in Chile are coming from the private sector. So there is attractive, and also Chile is a net importer of oil. So the mining companies are the ones who are bringing many of the renewable energy. So company to company, they are talking to each other to lower costs on energy. So that's one example. On the other sense, I would say the other countries are basically moved by public policies. Pemex, for example, in Mexico is again coming back, let's say, to a state approach. The same in Argentina. Of course, they have an urgent need to move into the tradables as soon as possible to be able to repay the formidable debt they have with the IMF. So it's not easy. China, as I said before, with the Belt and Road initiative, which I am also participating very actively, I can see a very interesting opportunities, but for South America, not for North America.
And this investment, do you expect, is China going to be the biggest impact there, more than the US? Talk about the Belt and Road a little bit in terms of how much of it is a sort of idea and a concept versus something that's really impacting these relationships in a deep, meaningful way.
No, it started out as a concept, and
Sure.
there are now real projects spread out around the world, and we have, $100 trillion infrastructure gap in the whole world. Fiscal policy needs political leadership and coordination. Where do we find that in the West, right? So there's a big gap here. But isn't the conundrum, which relates to some of your previous questions, to do development, sustainable development, to do these BRI, you need strong state capacity. You need state resources, you need state ability to mobilize resources, and you need political leadership and long-term vision. But that's actually at the core of why the Phase 2 deal is going to be very difficult. Because if you want to change China's political economy model, where the state is at the center and state enterprises are carrying out strategic and economic objectives, everybody's going to be disappointed. If you're willing to accept this different political economy model that is in China, there are modest changes that can be done to reach a deal, but the expectations have to be completely modest. So I think the conundrum is, on the one hand, we say we need to have a strong state to do all these climate change, environmental protection. On the other hand, China is being criticized for too strong of a state presence.
Okay. Bill, do you have any thoughts on that? Or is that just something that is what it is?
Yeah, look, I think clearly China has a particular economic model which has worked extremely well for China, and it will evolve, as it has evolved over the past several years. But Senator Trotter, we put out a report last week on the $30 trillion or so of private sector capital that's going to have to go into solving the world's climate problem. Not the public sector, not the state-directed, not the multinationals, but private sector capital. The biggest private sector capital destination is China. The second biggest is India, and it cascades from there. This is an enormous opportunity, and I would say obligation for the private sector to coalesce around this common theme. It has to do with getting basic measurements, making concrete commitments, and delivering on those commitments, and then marshaling the capital into the projects. These are projects that should be structured to be profitable for the private sector contributors, whether it's the contractors or the suppliers or the financiers. We know that there's a dearth of investable assets in the world, which is why we have these asset bubbles popping up everywhere. Here we have the opportunity to create trillions of dollars of assets that are attractive, long-term, matching the demographic profile of our societal liabilities. So I think this can be tackled by the private sector. And of course, if you've got strong government support behind that, that's an incremental catalyst.
Okay.
Let me come in here, what you're saying, because in the region, we have indeed another reality in North America, if I can say, and that is the migration paradigm we have between Central America, Mexico, the U.S. And I think that what is needed there urgently, and the U.S. is already doing something there with a very good program called America Crece, which has been launched by the White House, actually, which is a very important program with the IDB, which is willing to invest, well, a good amount of money for infrastructure, for, let's say, to make migration an option, not an obligation. I think this is important, and it has the private sector in it. We are working closely with that program to bring in the social, the environmental dimension to the plan. So it's possible. What we need is a vision. What we need is an objective. What do we want? And if we agree, as it's happening, I think, with difficulty, with enormous amounts of difficulties between Mexico, the U.S., and Central America, but it can happen. If the governments of North and Central America and the southern part of Mexico come together, agree on things, then the private sector will come. We're talking about a plan of $25 billion. It's not that much, honestly. Now, China is a totally different phenomenon. China is not going to invest in this part of the region for many reasons that I'm not going to explain here, but it will invest importantly in South America. Why? Because we have the two oceans. There is a deal of how to connect via train, via whatever, and China is doing a lot of work already. Has bought a lot of companies, energy companies, that are of extreme importance for the region.
I think also here it's very important to talk about the other dynamic, which is the ease of doing business, the access to labor markets, corruption, all this business environment that will attract the private sector to come to any major markets. And I also encourage that, unless you look at these issues, foreign investments won't find it very easy to go into emerging markets.
Are you getting good foreign investment?
We do,
interest?
actually. Again, the World Bank announced a month ago Saudi Arabia was the #1 reformer globally in terms of ease of doing business, #1 globally in terms of empowering women. So this is part of our transformation, and we think this is critical. Not only having the opportunity defined, whether it's logistic opportunity or investment, but also this access to capital markets and labor markets.
So talking of stability, obviously China politically is a pretty stable place. You know what you're getting broadly. Can you talk a little bit about what's happened in Latin America this year, and particularly in where you live in Santiago?
Chile.
So, Chile was always seen as this incredible success story for Latin America for many, many years. And suddenly, out of the blue in October, we had these protests that have continued and were really quite surprising to people. Can you explain what's happened there and why this has spread through Latin America?
You see, this is cross-cutting almost all the region. And we're talking about inequality, not poverty, because Chile, for example, has made enormous progress on poverty. Extreme poverty is 3.3%, which is really minimum. The problem is inequality. You have a country like Chile that is $25,000 per capita income, but when you go to the salaries of the half of the population have a salary lower than $500, lower. That's the maximum. You can have even $200. Okay, with this amount of money monthly, you don't have the capacity to buy this. Everything is private: education, health, pharmaceutical, transport. There's no subsidies for the elders like me. No. You pay the full price of everything. So the households have got into an enormous amount of debt to pay the schools, to pay. So the social unrest, the gota que derramó el vaso, you and I talk about it, the drop
straw that broke the camel's back,
was the rise of the prices of transport, 30 pesos. And the people in the street say, it's not 30 pesos, it's 30 years. And that is, and what happens then is that there is a medium strata of people that left extreme poverty. They are no longer subject to subsidies coming from the state. They now have to pay everything from their pockets, and it's not enough. So inequality, discontent, and inequality not only of income, but of wealth, and of treatment. I can
And
put
is there any sign that is improving, or there's any particular?
Well, you know, the thing is now the population wants, there's a debate about a new constitution. They want to reconsider the whole political and social pact.
But doesn't it come, I mean, ultimately it comes back, I mean, inequality, absolutely, but you need growth to generate
Oh, well, definitely.
the opportunities. And if Latin America is mired in this very low growth environment, obviously, and we talked a little bit before, sub-Saharan Africa as well has got this problem of very low growth. You know, how do you actually kickstart emerging markets in general when pre the crisis they were growing very, very much faster than the developed world? That gap has narrowed quite significantly. So how do we get to a point where some of these countries that need that growth to create the resource can actually do that?
Just let me finish one idea. If the product of the growth is going to the 10% top, that's the problem. You see, if in Central America the 10% richer and the 10% poor has 70 times income differences, and in Chile is 25 times.
But is that different than it was 10 years ago, 20 years ago?
Yes, I think so.
Okay.
I mean, I think concentration of wealth, because these countries are emerging, they are growing, but it's concentration. The problem for me is concentration, not only of income, wealth, opportunities, everything.
So what are the hallmarks of the countries that are succeeding here? I mean, you mentioned before Ethiopia and various places that are doing very well. I mean, what are they doing that makes this possible, that makes them more like China in terms of their growth?
So you mentioned sub-Saharan Africa. 2/3 of the countries in sub-Saharan Africa are doing just fine. Right? You mentioned Ethiopia, Kenya, Tanzania, Uganda, Rwanda, Ghana. These are Botswana. These are places that have good, healthy growth. Of course, it's been volatile. They've had challenges. I think it helps to generate strong growth if you start from a low base.
Yep.
Right. So and Ethiopia has been growing very nicely for the last 10 years. Right. 10 years of consistent, strong growth, but from a very, very low base. And obviously, it'd be harder to get the same kind of growth, 8% plus, for another 10 years. But what they've invested in along the way, largely with debt, very substantially supported by China, is infrastructure. They build dams and roads and bridges and transport facilities that are actually trickling through to the broader economy. Ethiopia is no longer subject to the violent famine cycle that we all remember from our earlier years, because they've found ways to preserve water and build irrigation systems. So, and that has been replicated in many sub-Saharan African countries, often punctuated by periods of political instability, where then the country takes a big step backwards. And that unfortunately is a feature in a number of countries around the world. But the key is to invest in the basic infrastructure
to get it going,
that allows the population to rise.
Okay, I'm going to go to questions in a minute, but there's two more things I just want to quickly go through. We've talked a lot about China. Historically, the US has been the big determinant of performance in emerging markets. What's happened to interest rates in the US, what's happened to the dollar. Is that still very much the case? I mean, 2018 was obviously a tough time. The Fed was raising rates, and that pushed through into emerging markets in the traditional fashion. Are, again, emerging markets writ large still very much beholden to that cycle in the US?
Absolutely, it still is. The global cycle is still much set by the center countries and center country monetary policies, but we have seen with financial globalization this great prominence of global banks, and that means that credit gets spread depending on the risk aversion levels and monetary policy to emerging markets, and they're still suffering from it or benefiting from it all the time.
So what's the context for you?
I agree totally with this, but I think also as emerging markets go through these cycles again and again, they are also creating some solutions to their problems through hedging instruments, through some reserves management and other solutions. But I totally agree that the fiscal policies in the West, impacts emerging markets significantly.
What do you think? I mean, if you look at the year ahead and where the Fed is and where the dollar is, I mean, do you see any particularly positive signs or negative signs from where that's likely to go?
Well, I'm going to start by slightly disagreeing with Keu and Mohammed, just because I love to do that. It's the resilience of emerging markets, as we call them sometimes. I'm not sure it's such a good label anymore. To the last round of dollar strengthening was dramatically less impactful than previous cycles. Why? Because countries have adapted. I mean, they're less emerging. They're much more active currency management, more frequently floating exchange rates. But of course, there are some big exceptions, and some of those big exceptions were big countries in emerging markets. Argentina being the obvious one. Turkey was
India
in that mix. India's had, I think, a different set of challenges. So no doubt, all these markets that we're talking about are sensitive to still the largest economy in the world and its monetary policy. No doubt about that. But it's manageable. It's now manageable, and that's already a big revelation. No country has the excuse of saying, we're a victim, we're a price taker. No, you can manage that, and countries are doing that. So when I look forward, I think the period of unusual dollar strength is probably behind us. I think growth is rotating out of the U.S. and actually into China. I mean, China is now stabilizing and slightly improving. The U.S. is still growing very nicely, but it's not the driver of global growth, unlikely to be through the next year or two. And so I think a lot of that monetary pressure actually comes off emerging markets.
Okay. One country we haven't talked about where you have a presence is India. I think growth is about 4-5% this year they expect.
Yeah, picking up.
And it's had some issues with protests and other things, and obviously a change in policy from government. Can you talk a little bit about India and its prospects, and just India versus China and the differences?
I think India is an unusual large economy in that it's relatively isolated. So it's less of its economy as a function of trade balance. But India has a constipated financial system right now, and big state-owned banks that are in need of capital, and a non-bank finance sector that has had liquidity challenges in the past couple of years, which has made finance hard to get to the real engine of Indian economic growth, which is SMEs, and it's a problem that's unique to India right now. Although it has been and will be replicated in many markets over time. But India can also deal with this because of the underlying the demographics, the propensity to invest, the quality of the workforce, the talent, the reform orientation of the government should provide tremendous impetus for Indian growth. They just have to do it.
You agree, Bill, that India maybe in particular moved from agriculture to services, and they probably missed that industrial
the industrialization phase
in the middle.
It's a fabulously dynamic economy, and I think with tremendous prospects, but definitely going through a tough time right now.
And how will the relationship work with China and India? How will that develop?
It's going to be very interesting. India is taking a very wise stance of not siding with either and trying to keep a relatively stable relationship with both.
Okay, what does that mean?
That means that most of the tension is just going to be between the U.S. and China. India is going to stay.
But is trade ramping up significantly between India and China? I mean, what's that relationship?
You're right. I mean, President Xi has a cozy relationship with President Modi, and there's really long-term commitment to work with each other both on investment, trade, and exchange and communication, which is needed between China and the U.S. So they're going to carry on forward.
Okay. We're going to go to questions in 1 minute, but I just want to quickly go around. If you had to isolate one risk, and I'm going to go around quickly for next year for the emerging market complex, as we've talked about, what would it be?
Lack of investment in the region. I think it's key to have more investment, public and private. Otherwise, we're not going to make it.
And is that a risk or a likelihood?
Well, I think it's a risk because we don't have enough, and we need to attract a private investment. But of course, the governments also need to push for that. We need public investment.
Okay, Mohammed, what's
governance? I think emerging markets are full of opportunities for investors and for potential ideas, even solutions for the global community. If the governance is fixed and people have clarity on where to invest and what's the landscape, it's...
Okay, Bill.
Populism and deglobalization, and I'll consider that one risk.
And where is that most likely to manifest itself?
It has originated from the U.S., but we've seen manifestations everywhere, Chile, and Lebanon,
they can just pop
Iraq.
up wherever they do. Okay. Okay.
In the immediate horizon, after the U.S. election, the pickup of trade tension.
And actually, we should just talk about this very quickly. Do you think that the outcome of the election fundamentally changes the dynamic with China, or has that relationship now just shifted?
No, I think this is beyond any particular president. I think the China-U.S. tension is a bipartisan theme, but I cannot predict whether trade tensions will ease or exacerbate.
When that comes through. Okay. Does anyone have any questions from the audience? There's a gentleman in the back there.
It's very easy to give out loans. Can I understand what is the situation regarding the loan repayment that China give to certain African countries? Because I'm a big investor, and I know that there are at least 6 or 7 loans that would never be repaid.
I'm not sure it's easy to give out loans. China has a lot of saving, but it's committed to infrastructure, which has a lot of experience in doing, and hope that that will have general economic benefits. But also, I agree that there's geopolitical influence as well, along with the Belt Road concept. I think that we need to be clear that emerging market debt is mostly a domestic issue. That still, at least up until today, the BRI-related debt is still a very small portion of the domestic debt. But I do also agree that where there is this great concept of doing these projects, there needs to be corresponding institutions that deal with these financial problems, such as debt, such as solvency, and there is a gap there.
So I'm slightly making these numbers up, but the default rate on project financing loans, BRI or non-BRI, in Africa is under 2%. The default rate on comparable loans, what is? I mean, we lend to 17 countries. The default rate in the US is 6.5%. So these are, it's a risky asset class, but it's not particular to Africa.
I differ with those numbers. I think that whatever you classify as defaults are probably a lagging indicator.
Okay.
Okay, well, maybe you guys can get together afterwards and work that one out. A question here.
I've seen, I represent Crescent Petroleum. We go to China a lot, and we've seen a huge improvement in quality in terms of what's happening there. But one thing we worry about is the level of debt as a percentage of GDP, which is growing in China. And that has an all-pervasive effect on the emerging markets because of Belt and Road Initiative and everything China is doing. I'd like to hear your views on how fragile that is and what effect it may have long-term on markets.
If we're talking about internal debt inside China, it's important to recognize a few things. One is, what is corporate debt is really state debt. It's government debt. It's the government owns the debt, local governments. Second, China's financial system is not going to suffer from a heart attack because there are a lot of immediate measures. There's a lot of state coordination, tell the banks to lend, and you will avoid that major crisis. But the worst case scenario is like Japan, where these debts are, these erodes productivity over time. It's a long-term issue, and banks become less and less competitive over time. But I'm not worried about a financial implosion. And lastly, the debt problem, in my opinion, is not the main issue and explains why China's slowed down. It's structural reforms. There's a political impasse. There's some hope that Trump's trade war can accelerate these reforms by having external pressure, but that can only work to a certain extent.
But is it also demographics? I mean, just the other day, birth rates were the lowest since the 60s, depending on how you measure it as a percentage or in absolute terms. I mean, how much is the demographics just naturally driving this lower?
I'm not worried about Chinese demographics. First of all, the Chinese government can still just completely let go of the fertility restrictions. One has to understand the new generation of Chinese are much, much more productive and much more educated than their parents' generation because of the one-child policy. And so if we look at the effective labor force, it's going to be much more meaningful than just counting the number of people. So just as China's rise did not happen because of demographic dividend, it's not going to slow down because of demographic aging.
Okay. Another question? Stefano? No? Please, here.
Hi, I mean, there's a question around emerging markets in the last crisis, managed that extremely well, in part because there was a lot of fiscal and monetary space globally. We've gone through a very, very benign credit cycle, lots of liquidity slushing around the world. Equity markets are at all-time highs. I'm not suggesting a crisis. I'm just saying if things slow down substantially and the credit cycle turns a little bit and there's no more liquidity and the fiscal space doesn't exist, how well do emerging markets what are the shock absorbers that allow emerging markets to kind of navigate that through?
Who wants to take that?
Well, you see, the thing is, I think we have a problem in the world because the debt, the global debt, is 320% of GDP. So the world in general is very highly indebted. Now, where is that money? The thing is, how do we take that money for the real economy? And that's the connection that we don't see, is the financialization of globalization in a way. So I don't know how to respond to your question, but I definitely feel that differently from 2008 when we had that crisis and all the world agreed on fiscal stimulus and so forth, some countries are getting ready for that. China, indeed, is providing some fiscal stimulus for its own economy, by the way. I don't know about the U.S., how the U.S. is going to react. I don't know about your part of the world. In my part of the world, governments are realizing that an active fiscal policy is urgent.
So, I mean, this is an important question, obviously, given where we've seen markets going, given the credit cycle. I mean, how risky is this?
I think what we've seen in the past, I mean, since the great financial crisis, we've seen a number of country-specific crises for countries that were vulnerable, countries that mismanaged their economies or had an exogenous shock, but usually mismanagement, one way or another. And I think we can expect to see that carrying on idiosyncratically, but then clearly if there's a global slowdown, the vulnerable are going to fall over. And it's always been the case, and it will continue to be the case. But there's really not much of an excuse anymore because there are the textbook is relatively straightforward in terms of what you need to do to not be vulnerable to a global slowdown. Some countries are assiduously following the rule book, and some aren't.
Would you give any examples of those that are most vulnerable and aren't?
No.
Thank you.
Argentina.
It's worth a try.
With the help of the
We can
IMF.
look in the rearview mirror. I can say Venezuela.
Thank you for that one. So we've got 2 minutes, or 1.5 minutes. Any final question anyone would like to pose to the panel? No? Yes, here, please.
Thank you. I'm Brittany, a global shaper from Kingston, Jamaica, actually. And this is not really an economic question, but more heart of the people. The young people do feel that these tensions are somewhat affecting our cultural identity. In a way, we lose a lot of our cultural treasures, land, and it's really tough. Yeah. So how would you suggest that we, as the future of these emerging markets, how do we protect ourselves, in real terms?
It's a great question. I have to say that I totally concur with you in the sense that we do need to change the paradigm of development. Let me talk about development and not growth. My view is that we need a paradigm that addresses 3 issues. One is economic. We need to grow. There's no question about it. But we also need equality as a driver of growth. It's not growing and then equalizing. No. Equality is a driver of growth. And the third element is sustainability. And I think young people are calling for this triad, which is trilemma, if I may. But we have to solve it together. Otherwise, the young people see that there's no hope in the future, honestly, because there's no hope in the sense, in the discontent stems from that. It's the youngest people who are very discontent. It's not the millennials, huh? It's the younger generation who is in the streets calling for something different, even violent, because they believe, like the Gretas of the, I mean, if Greta is worried from Sweden, think about the Gretas of Guatemala, El Salvador, Bolivia, Honduras. I mean, they are worried. They know they don't have a future. And that's where I think this World Economic Forum today and these days is trying to think through, I hope. When you say the big risk is deglobalization and populism, then what is the alternative? And I think we have to find an alternative with a new paradigm on development that brings these 3 elements together.
I think it's also a question of policymakers and what's their ability to really listen to the people and the young people in particular. And when I say that, it's not about going through a forum or tapping into an event. It's actually a continuous listening to the youth in particular.
it's a great way to end. So thank you very much for the panel, and thank you all for coming.
Thank you.